great.
Mark, thanks very much for a very interesting rundown of where you think we are in emerging markets at the moment. I'd just like to ask you about governance, particularly about state-owned and state-controlled companies, because there is a perception among some people in the markets at the moment that governance has deteriorated markedly, particularly for countries like Russia and Brazil, where the state seems to be pursuing an increasingly sort of interventionist role to the detriment of minority holders. Do you think that's, first of all, do you think that is a realistic assessment of the situation? And secondly, do you see that changing, perhaps in response to market conditions? Thank you.
It's a very good question, because corporate governance is probably the key factor that we look at when we first look at any company. Over the years, we've learned the hard way that if you don't have good corporate governance, you're going to be in trouble, even if the numbers look very good. Let's take Russia to begin with. Russia is a very, very mixed picture. And the reason why I say that is that you're going to find some companies in Russia have excellent corporate governance. They have protection of minority shareholders. They do everything by the book. I happen to be on the board of Lukoil, and if you look at the corporate governance, you can see it's very, very good. And there are many other companies in Russia that are like that. But then, as you rightly stated, some of the state companies have not been as good. But I believe in Russia this is going to change. And the reason why I say that is that the Russian government has programmed the listing of more and more state-owned companies, a listing of their shares. And in order to do that, in order to attract investors, both foreign and domestic, they're going to have to improve corporate governance. So I can see an improving trend in Russia. It'll take time, but I think that is going to happen going forward. But generally speaking, it has not been as good as, let's say, China. In China, the corporate governance of state-owned enterprises has been excellent. In fact, they've been bending over backwards to, treat minority shareholders fairly. In the case of Brazil, what happened there is that you have a populist government. Dilma, who took over from Lula, became more populist and wanted to transfer more wealth in the hands of the lower income groups with welfare payments, et cetera, and he wanted to raise taxes as a result, so that they have been promoting various measures to extract more money from companies like Vale do Rio Doce, which is the large state and listed iron ore company, Petrobras, the same thing, and so forth. So that's been a big, big mistake, and I believe it's scared away a number of investors. But again, the latest news we're getting is that the government is waking up to this reality. They're seeing, they're going to be in trouble if they continue these policies. So a lot depends, I think, on our ability to really speak out and tell these governments that they've got to improve corporate governance. When it comes, I'm talking about state-owned enterprises. When it comes to private enterprises, that's something that you have to leave up to the individual company, and the more pressure we put on these companies, the better. And that really is up to us, and which we do. We vote at every single meeting, and we let our feelings known to managements as much as possible. Thank you.
Any other questions? There is another question.
Mark, thank you. I was wondering if you could speak to, with respect to the differences between emerging Europe and developed Europe, the relative liquidity of the offerings that are coming out there, and any other factors you think that are keeping those numbers, or that would help reconciling the numbers between the returns.
Yeah, if I tried to put together some numbers in terms of the results of IPO activity. And if you look at the emerging markets generally, it's been, on the average, maybe, if you bought every single IPO, you would have made maybe 4%, 3 or 4%, which is not great. So it means that many of these were overpriced. And I think that is a key factor that you have to look at very carefully. It's great when you are in an extremely bullish market, then prices can go up nicely, but in a market which is sort of not very bullish, then you have to be careful on pricing. So I would say that up to now, generally speaking, the pricing has been a little bit high. And this is a problem, by the way, with privatization of state-owned enterprises, because governments don't like to sell shares cheaply for fear of being criticized later for allowing the so-called speculators to make a lot of money on IPOs. But I think that's a mistake. I think if they are afraid of that sort of thing, what they should do is say, okay, our plan is to sell 20% of this state-owned company. Let's do 10% now at a good price. Give shareholders an opportunity to make money. And then once the track record is established, then you can do more. But I would say liquidity is not a problem as much as pricing. That's really the key. And the pricing has to be reasonable. Yes, Gila. Oh, there's one.
Good afternoon. In your presentation, you highlighted the massive outperformance of Turkey in this region. Yet you are very positive on Poland. And just wondering, we've seen a bit of turbulence recently in emerging markets and Turkey specifically, also driven by politics. What are your thoughts from here? Is Poland now a better bet than Turkey, or do you remain very positive on Turkey going forward? Thank you.
We remain positive on Turkey simply because of a very dynamic environment you have in Turkey. You have a much younger population to begin with, and you have a rapidly changing business environment. So we're quite positive in Turkey because a lot of reforms still have to take place. But at the same time, Poland is becoming an important center for the rest of Europe, Eastern Europe. And I like the trend where Poland is reaching out to the rest of Europe to become sort of a capital market center. If this trend continues, this will be very good. The other factor that we have to look at for Poland is the pension system. If the pension system does not remain private, this could be a problem. Because if you have a government managing the pension system, there would be a tendency, I believe, to not have so much in equities, but more in fixed income because, you know, they want to be safe, at least appear to be safe. And also the reduction in the contribution to pensions would be a big problem, because you must remember this market would not be where it is today if it wasn't for the Polish pension system. So this is something we have to watch very carefully. So I would be much more bullish about Poland if the pension contribution was not reduced but increased. Because, you know, if you look at the rest of Eastern Europe, you'll see the pension contribution in Poland is rather low. You know, and if you look at Eastern Europe generally, it's very, very low when you compare it to Asia. In Singapore, you're talking 20+%. I forgot the exact number, but 20% plus of a person's salary goes into pensions in Singapore. So you can imagine the differences. Here it's what, 3-4%. So this is something we have to watch carefully.
If you have any further questions,
yes,
please introduce yourself
yes.
and go ahead.
Gila.
Hi, Mark. You stated very well in your presentation before how liquidity at the Polish equity market is significantly and continuously improving. Unlike in the rest of Eastern Europe, like Hungary or the Czech Republic, we don't talk about Slovakia any longer. What do you suggest can be done to improve liquidity in these other Eastern European markets?
In the other Eastern European markets, I believe the way to increase liquidity is to encourage IPOs. And you can do that in two ways. One, by listing more shares of public companies, government government-owned companies, bringing them to the market and putting more of their shares on the market if they're already listed. That's one way. The other way is to encourage private companies to become listed. How can you do that? With a tax policy. There are some countries in the world that have been very successful in having a policy whereby any company that is listed gets a reduction in their profits tax. Now, why is this? Of course, you talk to a government about doing this, they don't like it. But the reality is that their tax income will probably go up. Excuse me. Because a lot of money now in private businesses is hidden. It is not transparent. Once a company is listed, they must be transparent. So by listing, you're going to increase the profits coming in, and of course you're going to increase the tax income. So that's one measure which could be very effective in increasing the number of companies listed, not only in the Polish market, but in East European countries generally.
Hello.
Hello, my name is Miro Klepac. I come from Croatia. It's a country which will enter European Union with the 1st of July. I wanted to ask you, because you can split countries in emerging Europe to those who are in EU and those who are still not. Do you see any relevance in membership to European Union investor considerations in investing in emerging Europe? Thanks.
It's a great question, and I think it's congratulations to Croatia for joining, because I think it's the right move at the right time. I know a lot of people have been negative about Europe and about the euro. I have not. For the last 2 years, I've been saying Europe will survive, the euro will survive, and will get stronger as we go forward. What I mean by stronger, not necessarily the exchange rate, which has, by the way, remained very strong against the US dollar, but also stronger in the sense that the credibility of the euro will increase. And with Croatia coming in and adopting the euro, I believe you're going to have a much easier time in attracting investment. Because one of the risks that you have in investing around the world is currency risk. And if you're in a currency that you know and trust and is similar to other currencies, then it's easier to invest. And private investment, direct investment in the country will probably increase as a result of you joining. So this is going to be very, very important. By the way, another factor that we find in investing in Europe is that with a common legal system and a legal watchdog in Brussels gives us a lot of comfort when we're dealing with companies and countries around Eastern Europe. This is a very, very important issue, which, again, talking about corporate governance, if you have the ability to go to court under a European-wide legal system, it is very, very good.
Hello.
Here, Mark. Adrian Cartwright from Clifford Chance. There's been quite a bit of criticism and quite a bit of debate over the last 2 or 3 years about the IPO process. And that criticism has come in part from investors and funds looking at the IPO process and expressing some dissatisfaction in the way that it sometimes operates. I wonder whether you've got any tips for companies and their advisors who are bringing companies to market for the first time, but how to engage with investors. We appreciate any insights you have.
That's a good question, because we are often very dissatisfied with the timing of IPOs. Very often we'll get a notice 1 week or 2 weeks before that this IPO is coming, and they can't tell you anything about the company, but they want you to invest. They don't give you this, they have this prohibition about giving you information immediately before an IPO. And I think that's very important. You've got to prepare well in advance, at least 1 month in advance, giving investors more information about the company, doing a roadshow, of course, introducing the management to investors. So I would say the big issue is timing, to get a better feel for the company and giving more information. Other than that, It's really up to the investment manager, you know, the investment bank doing the IPO and the management to make sure that the pricing is reasonable, is at a good price. So I think it's really a marketplace-oriented kind of thing, but I would say the main problem is time. We need more time to analyze the company, to meet the management and make an assessment.
In the middle, please, Mark. Carl Tomei, would you say that emerging markets have benefited from the global crisis, with interest rates being cut to pretty much zero in developed markets, which allowed emerging markets to cut interest rates and attract yield-starving investors? With the talk now that QE might be tapered, or the end of it, are you worried about rising interest rates and maybe people leaving emerging market debt mainly, which will ripple to FX and equities?
Yeah, this is a worry that many people have expressed. They're worried that QE will end, and therefore the flows of funds going into stock markets, generally in the US market and European markets, will end, and therefore emerging markets will also feel the effect. But I'm frankly not that worried, and I'll tell you why. First of all, the biggest indicator for the Fed, Mr. Bernanke and his colleagues, is unemployment. And although there might be, you know, half a point change in the unemployment rate or a point change, excuse me, that's not going to have a big impact, because I believe that in many ways there is a structural unemployment in the U.S. which is not going to be solved easily for two reasons. One, you're paying people to be unemployed, and two, you have many people that cannot be employed. They're unemployable. There are about 250,000 jobs in the U.S. that are going begging because they can't find qualified people. So this is a problem, and that, of course, if you don't have this lower unemployment, the Fed will see no reason why they should give up on QE. Another factor is that one of the most amazing things that we've noticed is that inflation has not come up. You know, traditionally you would think that with this incredible increase in money supply, inflation would rise. It hasn't. So central banks around the world have the luxury of just keep on printing, not to worry about inflation. And another thing you must remember is that a lot of the QE money went into banks in America and stayed there, in a sense that they were building up their balance sheet and they bought government bonds. So that money has not gone into the economy yet, but is beginning, because now the banks feel comfortable that their balance sheet is strong enough and meets the requirements that they need to have, and now they're going to start putting that money out, which is why you see the emerging markets doing fairly well, and particularly the US and Western Europe's markets doing quite well, because that money is coming in to the markets. So I'm not too worried about that situation. You're going to see, you know, fluctuations from time to time, but generally speaking, I don't see any big issue there. I think there was another one here.
If you feel like asking questions, just raise your hand and go ahead. Oh, there is, in the middle. Just a moment.
Hi, Mark.
Yeah.
My name is Leila. I represent an English broker. We offer to our clients...
An English broker?
Yep.
In Poland?
Yep. We offer to our clients an access on Russian markets and foreign markets. But unfortunately, in 2013, we see that the volumes on Russian markets are decreased, then interest to Russian markets decreased too. We are trying to understand the main reason, despite of the fact that in Russia was done a big job in regards to markets, I mean exchanges, T+2 settlement, central depository, mega regulator. What is, in your view, the main reason of the losing interest to Russia? Thank you.
Yeah, the main thing that will improve the sentiment, and it's all about sentiment, there's no question. I showed you the valuations of Russia look very attractive. It's about sentiment. And what would change that is more information, more roadshows, more change in terms of corporate governance, and informing the public globally about Russia. And I'll give you an example. We were in Hong Kong a month and a half ago, and thank you very much. And there was a group of Russian officials and businessmen that came to Hong Kong and told the audience about their plan to list many Russian companies. They had a beautiful presentation. They were very presentable. They answered all the questions we had and so forth, but they didn't do enough of it globally. They've got to do this globally. They've got to go around the world, New York, London, Singapore, and so forth and so on, to tell people about what their plans are, what they want to do, and what improvements they've made, and what the facts are, what is the reality in Russia. And use people like us. We've had good experience in Russia. We've done 5 private equity deals in Russia, and all of them, with the exception of one, we've made money. So, it's not impossible. You're not always going to run into crooks and robbers and so forth and so on. Russia has turned out to be a great place for us to invest. So it's a matter of information and, of course, changing, gradually changing the corporate governance structure.
Good afternoon, Mark. My name is Alex, and I represent the Ukrainian broker. And what is your view on the Ukrainian markets in a couple of words? Thank you.
We have quite a lot of investments in Ukraine, and our analysts like the agriculture mainly because of the black soil in Ukraine is very, very rich, and they're very productive. So that's where we have the money in Ukraine, is mainly in the agricultural area. What I don't like about Ukraine, and by the way, this gets to the whole issue of corporate governance, is they don't pay dividends. And you have to wonder why these companies that are making so much money are not paying dividends. Now, I realize that you've got to expand and so forth and so on, but you should make the effort to pay dividends. So I would say that's the one drawback that you have in Ukraine. But our analysts generally like the agricultural sector in Ukraine.
I can see that here we have at least 2 persons that would like to ask questions. So, yeah, please raise your hand, and the hostess will reach you in a moment.
Hi, Mark.
Oh,
can you comment on whether you think there's a credit bubble in China, and to the extent there might be some excess credit, how you might think that might work itself out over the long term?
Yeah, in China, it's interesting. They learn from everybody else, and they learn from the U.S. And as you know, the U.S. had a crisis as a result of the collateralized debt obligations, CDOs, if you remember those, which were basically packages of mortgages put into a product called a CDO, collateralized debt obligation. And people were investing in that, not knowing what they were getting. And they were investing because they were getting a good yield and supposedly capital gains going forward. Now, China has gone through the same process, because you had a situation in China, you still do, where the interest rate in the banks, which the banks are offering, is very, very low and unattractive. So what happened is that they started developing what they call trusts, trust companies, which did more or less the same as the collateralized debt obligations, and that is they bought in these projects or loans. Some of them were based on a project, a road, a bridge or something, or housing development, or some of them were packages of mortgages or loans. And they started selling these to bank customers, but they told the bank's customers, look, this is separate from the bank. It's not on our books. It's not going to be on our balance sheet. Of course, this is unrealistic, because if your staff are selling these things to clients, when things go bad, they're going to go after the bank. So you have this in China. Quite a lot of money has been gone into these trusts. Some of them have gone bad, not all. Now, will the scenario that we saw in the U.S. during the debt crisis be the same? And the answer is no. Why? Because all the banks are government controlled. It's as if Salomon Brothers, Merrill Lynch, all of these banks in America before the crisis were government owned, which was not the case. In China, they are government owned. So they will be bailed out. And confidence will not be lost because people who are in the banks will know that eventually they will get paid. So it's a big, big difference. Now, it is true there's some ghost cities in China, you know. There's some city, you know, some places that you have huge buildings and they're all empty. But this is an exception rather than a rule. And if you look at the trend of prices in China per square meter of residential space, the trend is up. If you look at the trend of sales of residential property in China, the trend is up. So I have to ask people, if you talk about a bubble, that means that you have too much space and there's going to be a crash. But if your prices are going up and this property is being taken up, I don't see how you can have a bubble, if you know what I mean. Now, it's true, as I said, there are some places where housing should not have been built, and it'll take time to be filled. But going forward, I think they'll be able to fill those places. So you must remember that China has not really reached to the point of the U.S. where credit card debt, private debt, is very, very, very high. We haven't reached that point yet by a long shot. They will reach it, and there will be a crisis at some point in the future, like we saw in Korea, but not yet. So I'm not that worried about it, but I'm not investing wildly in the banks in China because we know they're going to have to keep on raising capital. By the way, one of the reasons why we saw this tremendous increase in IPO activity, which includes, by the way, secondary issues, was Chinese banks raising more capital to strengthen their balance sheet, knowing that they have these loans on the books, or they'll be responsible for these trusts going forward.
Yeah, go ahead. Andrew Filipek, Wedbush Securities. Mark, the recent financial crisis in the Western world caused accelerated regulation, particularly in the United States. Do you think that this make Central European market more attractive for the smaller company, for the emerging companies, that they can actually enter this market where is less regulation than US?
Yeah, one of the good things about Europe now, generally, not only Eastern Europe, but Europe in general, is that the news has been very bad. The news flow has been negative, and the flows of money in the U.S. have been increasing in search of opportunity. And some of that money is overflowing into Europe. And there are many small companies in Europe where the valuations are attractive, and you're going to see investors coming in to these companies. But also, by the way, there are a number of large companies in Europe, which, by the way, are becoming emerging market companies because more and more of their earnings are coming from high-growth emerging markets. So I would say, yes, there's many small companies in Europe are looking very, very attractive. In fact, we've started a small cap fund globally, and many of the stocks are in Europe, as well as an Asia small cap fund. And these companies are quite attractive.
I guess we still have time for 2-3 short questions. There's less than 10 minutes to go in this questions and answer session. But still, go ahead, in the middle. Okay.
Thank you. Mark, Franklin Templeton had been also investing in government bonds, and I just wondered how you felt about the region and government balance sheets in the region in general.
In general, as I pointed out here, that the debt to GDP levels in Europe and generally in emerging markets is low. And that's the reason, by the way, why you're seeing a lot of money going into sovereign bonds, corporate bonds in emerging markets. And of course, there's a danger there, because if it goes too far, then you're going to have another Asian-type crisis that we had, as you remember, in the past, 97. But we're not there by a long shot. Still, the debt to GDP levels in these countries is relatively low. And therefore, you're going to see these fixed income managers going into these bonds, sovereign bonds. We have an emerging markets fixed income portfolio that's pretty large. I mean, it's larger than our equity portfolio. So you're seeing a lot. By the way, it's really helped us, because last year I was visiting Sri Lanka, and usually I go to these countries to visit companies, and we didn't have any appointment with the government, but somehow they learned I was in town, and I got an invitation from the central bank. And it was an invitation for lunch, and so I went to the central bank, and they ushered me into this room with a beautiful layout of a lunch, and I said, gee, I really appreciate this. And the central bank governor said, well, we appreciate what you've done. Of course, I didn't know, because we hadn't, you know, I'm not in charge of the fixed income. I only do equities. And he said, well, you know, you purchased 20% of our national debt. And I said, oh, it's a small thing. It's nothing. And I had a very nice lunch.
Last question, please.
Yeah, last question. There's one there. Yeah.
Yes, hi. I represent Belarus. Igor Fuginsky, Afanasyev and Partners Law Office. I noticed at the start of your presentation that Belarus isn't in the center of Europe, and we are missing Arrow, emerging market. Question is why, and any hope for future to be included?
Which country?
Belarus.
Oh, Belarus. Oh,
yes.
Okay. Yeah, why didn't we have Belarus in there? We're interested in Belarus, so we have no problem. We would like to invest. The problem is you got to tell me where I can invest and how can I invest in Belarus. You know, one of the problems we have in all these countries, particularly now, you know, we have these frontier markets in Africa. They don't have a custodial bank, you know. This is a real big problem, because if we want to invest in, let's say, Iraq, we need to have a custodial bank that is acceptable by our global custodian. And that means they've got to have a big safe, or they've got to have a system for safekeeping. And I noticed the Prime Minister mentioned that, you know, you've made agreement, Poland has made agreement with a number of countries for safekeeping of shares, which is wonderful, because that, you know, allows you to have liquidity and so forth. But this is one of the problems with Belarus, but we're definitely interested. No question, we'd be interested. Thank you.
And thank you very much, Mr. Mark Mobius.